A $1 bill from 1926 looks practically identical to the paper currency we use today, but mathematically, 97% of its purchasing power is gone. This happens because every bill carries two distinct measurements. The nominal value, that number 1 printed in the corners, never moves, but its real value, which is its capacity to acquire physical goods and services, shifts every single day. In the 1920s, a middle-class salary could comfortably secure a newly built home for about $7,000. But today, median national home prices easily clear $400,000. Economists point out that these numbers are subject to hedonic adjustments. A home in 2026 is vastly larger, wired for modern electronics, and filled with advanced insulation. But even with those physical upgrades, the sheer numerical leap makes securing property far more difficult for the average saver. We see the same erosion in basic, non-discretionary survival goods. A century ago, a loaf of bread cost 6 cents, and a gallon of fresh milk delivered to your door was under $1. This animated diagram shows how sometimes the nominal price doesn't even move, but you still lose. In a process called shrinkflation, a bakery might keep their bread priced at $5, but reduce the physical size of the loaf from 20 ounces down to 18. You pay the exact same amount of money for less food. Because the physical paper in your wallet looks the same year after year, it creates a persistent illusion. It masks the reality that the baseline cost of maintaining a household is constantly moving upward. To track this upward movement, the Bureau of Labor Statistics calculates the Consumer Price Index, or CPIU. They monitor a massive, standardized basket of urban goods, everything from medical care to transportation, and measure how those exact prices change from month to month. The Federal Reserve, however, prefers a slightly different metric called the Personal Consumption Expenditures Price Index, or PCE. It's favored because it accounts for consumer substitution. If the price of beef spikes, families might switch to chicken. The PCE updates frequently to reflect how people actually adjust their spending to survive. Prices get pushed upward by 3 distinct macroeconomic mechanisms. The first is demand pull. In simple terms, this is what happens when you have too much capital chasing too few goods. Consumers and businesses attempt to spend money simultaneously, and when that demand collides with suppliers who have limited inventory, prices rise. We saw this clearly in the early 2020s. Government stimulus checks flooded the private sector with instant liquidity. As economies reopened, a massive wave of pent-up demand was unleashed onto a market that simply couldn't manufacture goods fast enough. The second mechanism is cost push. This happens when severe global supply shocks make raw materials incredibly expensive. If a geopolitical conflict disrupts global shipping routes or oil markets, it costs significantly more to manufacture and deliver products. Producers are forced to pass those extra expenses directly onto you. The third and arguably most dangerous trigger is embedded inflation, commonly driven by a wage price spiral. This occurs when continuous price hikes transition from a temporary anomaly into a permanent psychological expectation. This animated flowchart shows exactly how the bargaining gap operates. Workers expect their cost of living to go up by 5%, so they demand a 5% wage increase to protect their real income. Businesses pay the higher labor costs, but immediately raise the prices of their end products to protect their profit margins. That forces workers to demand even higher wages, creating a continuous feedback loop. Rising prices are rarely caused by one single isolated event. They are a complex reaction to sudden consumer demand, broken global supply lines, and basic human psychology. Managing this volatility falls to the Federal Reserve.
Congress gave the central bank a dual mandate: maximize employment and keep prices stable. To achieve that stability, they formally target an inflation rate of 2%. The origin of this specific number is surprising. It didn't come from a highly complex academic equation. It actually evolved from an offhand comment made by an official during a television interview in New Zealand in the late 1980s, which global central banks eventually adopted as a functional boundary. So why not target exactly 0%? First, there's measurement bias. Capturing the exact price of every transaction in the entire U.S. economy is practically impossible. When observed inflation reads 2%, the true systemic rate might actually be closer to 1%. Aiming slightly higher ensures the Fed doesn't accidentally overshoot into negative territory. This animated gauge shows the concept of the zero lower bound. Interest rates and inflation are proportional. By targeting 2%, the Fed ensures baseline interest rates remain high enough during normal times to create a physical buffer zone. If a severe recession hits, they have enough room to actually cut rates and stimulate borrowing. That buffer is critical because the alternative is deflation. Falling prices might sound great for a grocery run, but they devastate a broad economy. If consumers know goods will be cheaper tomorrow, they delay spending today. That starves businesses of revenue, triggering mass layoffs and systemic defaults, exactly like the deflationary collapse seen in 1932. The 2% target operates as a deliberate macroeconomic insurance policy. It accepts a slow, predictable rise in prices to prevent the entire system from locking up. Because this 2% erosion is baked directly into the system, holding pure cash in a mattress guarantees a loss of purchasing power over time. Defending your wealth requires deploying specific financial shields. This side-by-side bar graph shows how Treasury inflation-protected securities, or TIPS, operate. They are government bonds where the underlying principal actively adjusts. As the CPI bar rises, the TIPS principal expands in exact lockstep, meaning the baseline value of your money physically grows to match inflation. But there is a catch regarding taxes. The IRS taxes those semi-annual principal adjustments as phantom income in the year they occur, even though you don't actually receive that extra cash until the bond matures or is sold. For individual retail savers looking for a simpler alternative, the government offers Series I savings bonds. These non-marketable bonds pay a composite interest rate, which includes a variable rate that automatically recalibrates every 6 months to match current inflation levels. They do carry strict liquidity constraints. You cannot cash out an I-bond for the first 12 months. And if you redeem it before holding it for 5 full years, you forfeit the previous 3 months of accumulated interest as a penalty. For pure long-term growth, broad market equities remain the historically dominant hedge. While Treasury products preserve your existing power, the stock market is structurally required to actively grow real wealth. This line chart shows the proof in the data. Between 2025 and 2026, standard CPI inflation eroded the value of cash by 3.8%. But during that exact same period, an S&P 500 index fund delivered a nominal return of 11.66%. By outpacing the inflation line, the market provided an actual, real return of roughly 8%. Inflation is an unavoidable, structural reality of modern fiat currency. But by understanding the mechanics behind it and utilizing the right treasury and market assets, you transition from a passive saver into an active preserver of your wealth. If this helped you understand how your money actually moves, tap the like button and subscribe. And drop a comment below. What is one specific price you've watched go up lately?